know him very well. Chiara Scotti is Senior Vice President and Director of Research at the Dallas Fed. It's actually a recent appointment. She was at the Board of Governors for most of her career since 2005, focused primarily on financial stability, but she's also been a special advisor to Vice Chair Richard Clarida when he was still there. And then last but not least, my former boss, or my boss's boss, I should say, Axel Weber. He is currently the president of the Center for Financial Studies at Goethe University. He's also chairman of the Trilateral Commission of Europe. He's still a member of the Group of 30, and of course he was the chairman of UBS for 10 years, and before that he was president of the Bundesbank. So with that, let's get started. Robert, the floor is yours.
Thanks a lot. Thanks for the invitation to the last panel. Let me start with the observation that we have too much inflation, including for the use of titles. This includes new trilemma for what we are talking about. And if I understand correctly, what is meant is the trilemma between fiscal policy, financial market stabilization, and monetary policy. Well, my understanding, we may have cases of trade-offs, and we're approaching to that, but at the moment we don't have a trilemma, because in the normal circumstances, and even under stress, we can keep them all together. The first part is, we know well that we talk about the separation principle between monetary policy and financial stabilization, which we want to keep, and it can be done. This is something which we have experienced more recently, that yes, we can do macro-pro, we can do monetary policy, and we can keep both separate. And the other part is, in many cases, fiscal and monetary policy are very much complementary. We had it when we had the crisis, COVID, and when we had the energy crisis there. And there are also a number of overlaps in policy when we talk about financial stabilization and fiscal policy. In both cases, we are talking, there's an enormous need to build up reserves, building reserves as a critical element. If I don't do it, then you get a problem, but there's not the problem of the policy advice there. This is the first part. The second part is, even if there were to have some tensions now, if there were to be some tensions now, and I'm sure the colleagues will talk now, is it a hard landing or a soft landing, and what will happen? My take is, and what I do is, I cast my mind well beyond whether it's one of both. So the question is, and what will be monetary policy then? As R star is likely to remain low, there's no reason why it should increase. What kind of monetary policy should we apply then? Well, unless we find some quick solution, good solution, important solution, it will be the same as before. We will have to do unconventional monetary policy. We may improve it, but for the time being, I've seen very few examples of improvement there. And this means then we will have to use again QE, negative interest rate, perhaps delta again, in order to make the vehicle work. So if it's a hard landing, then in particular we will have to use them. But what does it mean then for the balance sheet? The balance sheet of a central bank, which became negative in many cases now, it will remain or will become even stronger negative afterwards. So in order to avoid that, I think while we are talking about what to do, we have to think about what can we do now in order to avoid negative balance sheets, for the simple reason that if we continue with negative balance sheets of central banks, their independence is quite likely to be in danger, and this is something which occupies me very much. Thank you.
Great, thanks very much. Hugh, over to you.
So first of all, let me also thank you for the invitation to be on this panel and say what a privilege it is to be on the stage with such a distinguished group of fellow panelists. I would also like to pick up on the theme of trilemma to kick us off I fear that I'm going to repeat some of the same things. That might not be making for a very lively panel, although I hope it makes for good policy going forward. And I basically wanted to make 3 points to kick off. The first is, I'm also skeptical that we should characterize the situation as a trilemma. I think we have learned a lot from the last century of macroeconomic policy. And one thing that we've learned is that different policies should be assigned specific targets and given independence to pursue those targets. In my sort of day job on the Monetary Policy Committee at the Bank of England, that is affected by having independence of monetary policy to pursue price stability, which is an objective monetary policy is well designed to do, in the form of an inflation target that's assigned to us by the government. And I think that is what we are striving to do, that is what we have done, and that is what we will do. And similarly, although the objectives of other policy areas, be they macroprudential policy, fiscal policy, are perhaps more complex, less easy to define, and that brings with it its own set of challenges for policymakers in those areas. I think the independence of policy and the famous Tinbergen assignment of one policy to one objective remains, in the overarching sense, the framework which has served us well. I think it continues to serve us well, and we should not complicate that unnecessarily. Second point I wanted to make, and I pick up on exactly the word you used, is the point that it is easy to overstate, and I think it is often overstated, the degree that trade-offs or tensions may emerge across these three policy areas. In general, there are strong complementarities. So speaking from the perspective of someone as a monetary policy maker, financial stability, well-functioning markets, resilient institutions, those are all elements that support the transmission of monetary policy and in a sense are central to us achieving our aims in terms of price stability by setting interest rates, influencing the size and composition of the central bank balance sheet in pursuit of our objective. That's something that's both facilitated and supported by effective maintenance of financial stability. And equally, I think we've seen of late that fiscal policy respecting long-term sustainability, being well communicated, well designed, etc., is an important element of supporting macroeconomic stability and creates an environment within which monetary policy can operate effectively. So I think the crucial thing is that we have clarity of responsibility, independence and accountability for those using that independence, and we have open and transparent communication across policymakers. And that brings me to my third point. So we are all, or at least I am, a sort of central bank nerd, and so we do get very excited about quite specific technical issues. So I don't want to call you a nerd, sorry, that was a bit rude, but focusing on the volume of reserves, how we manage that and so forth, I think there's a lot of interesting issues there, and we can get bogged down in detail. Those details are very important, but they're quite technocratic issues. And so I think in our communication, it is important that we focus on the big picture. And I think that big picture remains one where independence of action, focus on objectives, should be the sort of key element. And the technocratic elements will sort out the details, the trade-offs that may emerge. I think that was quite evident, and maybe we'll talk about this in more detail later on. I mean, exactly a year ago, we went through this episode in the UK where, in real time, I think it was characterized as a lot of difficult trade-offs across monetary policy, financial stability considerations, and fiscal policy. I think when you look at that with a slightly more distant perspective, I think you do see how, first, these complementarities play out, and second, how important respect for the broader institutional structure, of which independence, accountability, and transparency are key, how crucial that is for effective policy implementation. So I'm sure we'll talk more about the conjuncture as we go forward, but where does that assessment of this trilemma issue lead us from the perspective of a monetary policymaker? I think on the one hand, it leaves us with, we have to rely on our colleagues in the fiscal and macroprudential space to do their job, and we expect them to do their job. And what we have to do is do our job. And as has been said, and here I speak perhaps more specifically for the UK, inflation has been too high, it remains too high. We need to return it to target. To do so, we have tightened monetary policy. We have done a lot over the last 2 years. A lot of that policy is still to come through. There is still policy transmission in the pipeline. Whether we've done enough or whether we have more to do, I think is becoming a more finely balanced issue. But we will do what we need to do in order to have inflation at 2% on a lasting basis. Let me stop there.
Great, thanks, Chiara.
Good morning, everyone. First of all, I feel like I need to start with the disclaimer because no one said anything, but I just want to make sure that these are my views so that I can speak freely. They do not represent the views of the FOMC. Second, thank you for inviting me. It's great to be here with this esteemed group of people. I feel like I could start by saying all of the above, but that wouldn't go well. So let me try to rephrase a little bit how I'm thinking about these issues. So to me, this trilemma, has sort of always existed. It's just that, in this new era of monetary policy, we've become more aware of it. I think it started with the great financial crisis where we became more aware about the linkages between financial markets and the real economy, and so financial stability and monetary policy. And then with the pandemic, we became more aware of the linkages between fiscal and monetary policy because both fiscal and monetary policy were really needed during the pandemic to avoid what could have been a much deeper and longer recession, and both helped to pave the way for a stronger and faster recovery. But here we are, like 3 years from the pandemic, and I think we've all seen what has happened. We've had a very strong demand that outpaced supply that was constrained from a supply chain network that had issues, as well as we've had a number of shocks that created an increase in global inflation. So like everyone else here, monetary policy is focused, at least at the Fed, on the dual mandate on price stability and employment. In terms of price stability, inflation has been coming down, and we've had some good news during the summer. We're still not, where we would like to be, and there are a few things that will need to happen. But we've been looking at different measures of inflation. You know that we follow primarily core PCE inflation. Because I'm from the Dallas Fed, sorry, I have to put in the Dallas trim mean. I don't know if you guys know what that is, but it's a measure of inflation where you sort of take away the outliers with the idea that those have a lot of noise. And that is also, the Dallas trim mean has also been coming down. However, lower inflation is not really low enough inflation. And so, we have to keep looking at other parts of the economy to make sure that they will help us to bring down inflation. And one of the places where we're looking at is the labor market. You've seen the news last week. JOLTS came in higher than market expected. Non-farm payroll was a whopping 336,000 jobs that were added. Still, we also have some good news because a number of other measures have been decreasing to 2019 levels. We've been looking at the quits rate, which has been coming down. Wage growth has also been coming down. So I think we're all in a good trajectory. And so, this is just to set the stage for, I think, the job that we are doing in the monetary policy world, taking as given the fiscal policy and also working in looking at the financial stability issues that are out there and that could affect the way that we work with monetary policy.
Okay, Axel.
Thank you. Pleasure being here, and also great to see so many friends in the room, and thank you for being invited to this panel. Usually when I give talks nowadays, I prepare a few slides, but since I would have been the only one, I will not use them. But I will just briefly go through a number of points that I usually make when I talk about monetary policy. The first fact, and I think that's important when you want to look at what's ahead in terms of transmission mechanisms, there are a number of issues related to the balance sheet of central banks, is if you look at the equity boom over the last roughly 15 years, it has largely been driven by the amount of liquidity that was put into the system by the Federal Reserve, the European Central Bank, and the Bank of Japan. There's a pretty tight correlation between the S&P 500 and the amount of liquidity added to the system. Now, we were in a situation, as Robert said, where the central banks have been massively expanding their balance sheet, and we are getting to a situation where now inflation has become the key problem for some time. That's why we've seen a rate hike cycle. Monetary policy has, in my view, reacted late, if I say too late, to the increase in prices. I think initially there was a certain misperception that this would be transitory as opposed to more persistent. And then basically the central banks then reacted. I think they reacted in a determined fashion once they recognized that inflation got out of hand. And central banks are now, as you was just saying for the UK, really sending a very clear signal that it's 2%, we need to get there, and we will do what is necessary to get there. And I think that's the only communication that central banks should embark on. So I absolutely endorse the message. Any discussion about the target, how to get there, is a discussion you can have once you've achieved the target for a longer period of time. I always compare where central banks are, 2% inflation target. That's where airplanes fly at 30,000 feet. Imagine an airplane through storms getting an uplift to 150,000 feet. You would think there's something wrong with the autopilot, but then you definitely try and go down again in order to risk to not risk colliding with the satellites, which fly somewhat higher, that you go down to the flight path at 30,000 feet. And getting to 30,000 feet is absolutely essential for central banks not to cause a lot more damage. And so I think it's absolutely, and in that sense, I don't see a trilemma, not even a dilemma. There's just one objective, and they need to get there. Monetary policy has, as I said, reacted in a firm way. I was talking about inflation problems somewhat earlier, I think at the early time, Larry. I look at something different, and I don't want to go into, as you rightly said, the nitty-gritty of details of models. But I usually look and start with the price level. Having been an econometrician, I really start with the price level. And you could see that a global 25% stimulus in the US in particular to paychecks, where a huge additional income was created by transfers from fiscal policy, largely funded through a almost same size expansion of central bank balance sheet, led to massive available incomes at households without the usual production that comes with these incomes when they're generated through production. So you did have a massive gap between demand and supply, and you had some bottlenecks and some dislocations of shipping, etc. You get a triple whammy of a more persistent, a more transitory negative supply shock, and a huge positive demand shock. Well, economics 101, I usually tell my students, expect inflation to be the outcome. And you did see that actually price levels started taking off at the end of 2020 with a pretty deterministic rate of 8%. Not 6, not 4, not 2, 8%. And the central banks, by being very determined, have eliminated half of that. And the first 4% reduction was a pretty easy run because there was a lot of transitory factors in there, particularly in Europe where the war of Ukraine, energy, all of this stuff that is transitory. The difficult part, in my view, will come bringing inflation back from, say, around 3%, where a lot of inflation expectations historically have settled to 2%. And I think that's where the determination of central banks is very important. I don't need them, I know them by heart. So I just use them in case I want to look at the figures, but I don't need them. So if central banks are now doing this, there's two problems. The first one is because of starting at different conditions and starting late. We've seen the most massive rate hike cycle in terms of distance between low and high covered. Central banks moved by more in this normalization than they ever did in post-war history. They didn't move with the largest steps because Paul Volcker did like 1% steps, but if you look at the speed, this has been the highest and the shortest rate hiking cycle in history. And if you look at global rates, it's been the most synchronized rate hike cycle that we've seen in history. So steepest, most condensed, and most coordinated. Or not necessarily coordinated because the central banks in emerging markets move first. What do I expect? I expect this to still have, and you pointed the finger to it, massive effects in the pipeline of monetary policy normalization. And what I expect, and we talked a bit before coming in here about the channels at which this will now hit the economy. Usually if you're a monetary economist, you'll worry about 4 channels of transmission. One is the interest rate channel. At 0 rates, that was largely switched off. It's back with a vengeance. The second one is basically the, it's the channel that goes through portfolio choices. Equity was the choice for every investor for years to come. Now, interest rates are back, bonds are back. You can get a real return on bonds now in the US that's around 2%. So you will get a quite different portfolio allocation in the world, and financial markets will move big time. Exchange rate channel. The exchange rate channel hasn't really moved a lot because so far a lot of this has been pretty much synchronized among the major countries. As they're moving to more steady state, other factors will come in, and I do expect that sort of exchange rates won't be quite as calm at the new level of interest rates unless they're held for a very, very long time, because the historical pattern is while rates go up in sync, they usually don't come down in sync, and so there may be in that adjustment further exchange rate. And then the last one is really the income and the wealth channel. What used to be a headwind for financial markets is now, what used to be a tailwind for financial markets is becoming, with the central bank balance sheet reduction, more of a headwind. I don't worry about that one because the central banks do the right thing. Liquidity injection was always done when it was needed, so it came and it had an effect. Liquidity reduction, if you look at the charts of the ECB, it's like melting a glacier. It's sort of, at a predetermined, almost deterministic rate, not create any news. This will melt down over years till the ECB's balance sheet is again largely composed of cash on the other side. So this is not going to be an event unless there are rocks in the road and central banks need to do what they did around Silicon Valley or what the British central bank needed to do around the insurance business problem. That is, on a general path of reducing liquidity to do emergency liquidity assistance into the system, which can create some volatility. And outside central banks, it's not as well understood that these are 2 totally different animals. And so the market, I think, that will complicate communication for the central banks. Are we heading into trouble? I think I'll give you the answer in 3 years. Because we are at a point in time where this rate hike cycle, because we're almost done, largely done, but we've not seen the impact of that through the various transmission mechanisms because it's just too short. Don't think the fact that you didn't see a lot of repercussions means that there will be none. This would be like jumping out of an airplane without a parachute and saying at 10,000 feet everything's fine so far. We're going to see more of that problem in financial markets, and I guess if you keep going on about the plane comparison, keep on the safety belts. Thank you.
Thanks very much, Axel. So why don't we start actually with your last point and whether or not the bulk of transmission is still ahead of us. I mean, one of the things that's been puzzling and I guess surprising to people is the resilience that we're seeing in lots of the data, right? So if you look at European profits, for instance, they look incredibly resilient, actually more so than the US. You look at sort of some of the cyclical parts of the US economy, like new home starts and other things, still looks very, very resilient, really surprising given the supposed interest rate sensitivity. You look at the labor markets are super tight. So you can just go on and you can just find all these things that haven't responded in the way that I think most people thought they would respond. So I'd just like to get from each of you sort of your take on what it is we're seeing. Is it reduced interest sensitivity of the economy? Is it some kind of pandemic till, or is it simply, as Axel says, the transmission is only just getting started? So, Robert, can I maybe start with you, and then we'll go down the line.
Indeed, the transmission is not as expected, and I would start with the first, which is perhaps the most surprising one, has to do with the labor market. Because normally what would expect if and as the situation deteriorates, that the labor market also will get a share of it. But what we see, the labor market remains tight, less tight perhaps than a year ago. And what we also see, major changes in the composition of the labor market. What we have there is that we still have an increase in the labor force participation in most cases, which is astonishing at this moment when one thinks there may be a reduction. But what we see at the same time as well, we have a reduction in many countries, particularly in Europe, but not only, of the number of hours worked. So we see this dichotomy, which we have difficulties to explain. And this leads then to the question, if we have this development there, what does it mean for the sensitivity? Well, what we also see is that particularly this labor, the hours worked, where is it coming from? Is it because what usually said, it's the hoarding by the employers? They're afraid they don't get special workers if they fire them now? Or has it also to do with a major change among the labor market participant linked with COVID, linked with generation X, Y, Z welfare? And this is something we have not yet found a clear answer, because if and as their reaction is different than what we had before, then also our instruments is not the same. And what we see there among the youngsters is that, yes, they truly want to work less, best only 4 hours a week there. What we also see is that even if they work less in one job, they may want to use the rest for a different job. For example, being at the National Bank for 4 days, and the 5th day they become musicians. So we have this kind of changes which we have difficulties to explain, and which is a major part of the transmission channel. Then, of course, at the level of enterprises, what we have seen there, it may have been linked with the pandemic, and then later on with the difficulties of getting supply, that in many areas where they could, they applied their price-setting power rigorously. So the profits went up, and so they were somewhat cushioning their future positions there. And so they're in a quite comfortable position. But, and this is the last point, then what we currently see, and this is the unknown, that's the reason why it's much important to keep the lid on it on the interest rates, and perhaps even think about an increase there, has to do with the price setting. At least in Central Europe, the metal workers have not set yet their prices, and more recently also the civil servants in Germany, and the wage demands there are well above 10%, sometimes to 20%. And of course, if this were to succeed, and with a given tight labor market, they're likely to succeed at least to some extent. From this side, I expect not synchronized across the European area, which makes things worse, quite some inflationary pressure, which we will have to fight in the future. Thank you.
So just to follow up, so my mental framework would be something along the following lines that, basically if demand is strong, then obviously profits are not under pressure. If profits are not under pressure, then no one's going to get fired. If no one gets fired, then you don't get the slack to get the inflation down, right? Are you, when you look at sort of European profits, is that for you an important, because the ECB has been quite vocal about, and in their economic bulletins as well, about monitoring sort of the profit resiliency, and I think early in the year, complaining is not the word, but sort of highlighting it as something that really needed to come down to become confident that we would get some changes in the labor market that you pointed to. So is that sort of, how do you think about sort of the importance of looking at those profits?
Yeah, when profits in determining the inflationary pressure have come down, they're very high in 22, in the first half of 23. It is typically a cycle that profits go first. Now they have been replaced by the wages there, and here the cycle is not yet ended. But the profits, which have been well beyond which perhaps one could have expected, so in some cases they were extraordinary, which means that the enterprises have enough wiggle room. They don't have to react immediately in order to increase them to stay solvent. So I think this is my take on it. But of course it doesn't apply to everything. In industry, quite definitely, given in particular if they use high levels of energy, they're badly hit. And so the data we have for not only for Austria but also for Europe is that this is an area where a major restructure may take place because they were under heavy pressure both from the market side as well from the wage side.
Hugh, what's your take on sort of some of the resiliency that we're seeing?
Well, the first thing I'd say is I think when we talk about resilience, I think we have to think about resilience to what? And I mean, I think we're talking about resilience to a set of shocks, which Axel described. And these have been very big shocks. So, I mean, in some sense, it's the combination of the pandemic disruptions, the war and its implications for energy prices and food prices. And the question is really, why have we not seen the economy respond more negatively to that set of very big shocks in real terms? And we have like a natural experiment at the Bank of England because we did a forecast in the summer of 2022 where we forecast on the basis of first gas prices, which are very important in the UK, given our dependence on imported gas, remaining at their all-time highs forever, and no fiscal response, right? So our conditioning assumptions for the way we produce our forecast embedded those two things. And that led to a very, perhaps unsurprisingly, a pretty bleak outlook for the economy. So if you try and think about where has the resilience come from, I mean, some of the resilience relative to that baseline has come from the fact that those conditioning assumptions are wrong. We've seen a very big set of fiscal support, particularly for the household sector, in the form of support to keep gas prices at a manageable level. And we've also seen, through time, a significant reversion of European wholesale gas prices. Not a complete one, but nonetheless a very significant fall. And those two things, I think, help explain quite a lot of the resilience. The former being a response to, and the latter being perhaps some correction of the very big shock that we faced in the spring of last year. I think you could make a list. There's also the issue of excess savings accumulated during the pandemic period. I mean, I think we increasingly think that those have now been used up, but they have acted as a buffer supporting domestic spending in the face of these shocks. I think there was a long debate before I joined the bank about whether those excess savings would create a consumption boom in the UK, perhaps become a driver of inflation in themselves. I think the experience has been that we haven't seen that consumption boom. In fact, per capita household consumption in the UK has remained weak throughout this period, largely because these shocks have weighed on it. So I don't think that's been the cause of the inflation, but nonetheless, it's been a cause or support for the resilience that we've seen. I do think, and I won't repeat all the arguments we made, but the experience in the UK has been similar. The labour market is key here. I think we're still trying to understand, to be frank, what the implications of what in the UK was called the furlough scheme, the very aggressive set of fiscal measures, supporting measures to support the labour market during the pandemic, what implications that had. At the day that scheme ended, we still had 600,000 UK jobs supported by fiscal measures. You might think that when those fiscal measures ended and those jobs were sort of normalized, that might release labor into the labor market and create some looseness. The statistics tell you that did not happen. The behavior of the labor market, wages and employment tell you that did not happen. We can have some conjectures about what that means, but the uncertainties around that period, I think, weigh on our interpretation of the labor market going forward. I mean, looking forward from here, we've had less favorable developments in labor supply than elsewhere, particularly over the last year. So long-term sickness has been an increasing reason for people being outside the labor market. We've also, of course, through leaving the EU, changed our arrangements around migration, and so that may have some implications for labor supply. I think that may also mean we have less flexibility in the labor market, and more generally, I think there's issues around mismatch in the labor market. And I think increasingly, given difficulties in recruiting, we're seeing labor hoarding behavior and sort of perhaps the re-emergence of insider-outsider dynamics in wage setting. We certainly see a big discrepancy between what surveys tell us about new hires, what they're being paid, versus incumbents and what they're being paid. And that type of discrepancy would suggest that the labor market may be behaving in a different way. And I think the key question, which is exactly the question you raised, is how much of that type of behavior is a consequence of an environment which has not seen a lot of squeeze on insolvencies and so forth and so on. And are we now moving with higher interest rates with a less favorable overall demand prospect in a different direction? So that is a key area of concern or focus of our analysis. Unfortunately, I think I would just recognize it's an area which is important. It's also an area where the statistics are in flux, and so we have some issues about interpretation there. And then finally, I just wanted to make one point around monetary policy transmission, which I guess is the other leg here, and you hinted towards this, is part of the reason for resilience is that very strong monetary tightening that Axel described, has it not yet fed through? So I just would make 2 points briefly, and then I'll pass on. I mean, I think I would very strongly agree with the point about the synchronization and the lack of an exchange rate channel. I mean, the UK, relative to others represented here, is a smaller and more open economy with its own exchange rate. I mean, we would normally expect the faster transmission to come through exchange rate effects. We have not really seen those exchange rate effects. So that would explain why transmission may be slower relative to the average. But I agree with Axel, that does not necessarily mean we won't see those come through in future, maybe as more diversification across countries takes place. And then I won't go into this in details, it's a bit esoteric, but of course in the UK there was a lot of focus on mortgages and the fact that mortgages have shifted from being indexed to the policy rate to longer dated 2 and 5 year rates. I mean, I think there has been a discussion about whether that slowed down transmission and added to resilience in the face of monetary tightening. I have to say, I think the evidence there is still open. So if you want to go into that more, we can talk about that. But that would be my sort of high-level takeaway in that space.
So not to put words in your mouth, but so if I listen to your list, so there might be some delayed transmission because of changes in mortgage structure, but you haven't really highlighted anything in terms of, you know, firms or households having, other than mortgage, obviously, having become less sensitive to interest rates going up. So a lot of what you're describing is things that are related to the pandemic, the sort of exogenous shocks, fiscal policy, shifts in labor market because of immigration, sickness, et cetera. Those are the things that have really sort of shaped, I guess, where we are, as opposed to some kind of reduced interest sensitivity reduction.
Yeah, so I think that's right. I mean, that's certainly, I guess, our current assessment. I mean, you know, if you cast what you said into the sort of space of econometrics, it is difficult to identify monetary policy separately when there's lots of other things going on. So that brings with it a whole set of caveats, of course. But I think as the high-level sense of where we are in the UK, I think you summarized it well.
Great. Chiara, I mean, the US is really the poster child for resilience right now. It's particularly in some of the things that really everyone thought should have been going down, not up, right? So things like new housing starts. But what's your take on what's going on in the US?
So I can walk you through the way that I've been thinking about this issue because, of course, it's been on our mind for quite some time. And with my staff, we actually did some analysis to try and understand what is going on. Our starting point was a paper by Romer and Romer in 2023, where they take 9 historical episodes in which the Fed started to raise rates following high inflation. And they look at the transmission mechanism on unemployment, GDP, and inflation. we sort of tweaked the analysis because we didn't agree completely with the assumptions, in particular, the rise in interest rates. They had it in July 2022. We moved it to January 2022. Possibly, some people claim that you could even move it earlier than that because of, the announcement impact. But what we found is that based on those historical episodes, in this particular situation, we should have seen already the transmission having played out when it comes to unemployment and GDP, but still the bulk of the effect, or at least a big part of the effect, still to play out on inflation. Now, can we completely trust the results? I think that exactly what Hugh was saying, we've been in a period of very high uncertainty. We don't have a full view on every piece of data. And so where we are at the moment is that there are a number of scenarios that we are looking into. There is a scenario where you look at things like, for example, the nonlinear Phillips curve. Don't want to get into too many details, but the idea is we've been having inflation coming down without really an increase in unemployment. That could be due to a number of factors, and you mentioned, some of the things at play. It could be due to the resilience of balance sheets for households and businesses. It could be due to labor herding by firms. It could be due to the fixed rate mortgage that almost everyone in the US has, with very low interest rate locked in. But it could also be due to more structural changes. And so then in that case, you have to look at, the long run neutral rates. And then there are, another sort of considerations out there. I think that overall, we really have to be humble. We do all the analysis, and I think we have some priors as to what is guiding us. But at the same time, we have to look at the data as they come in to try and identify exactly, in which sort of scenario we are in. So this is where I personally stand with monetary policy transmission and the lags.
Great, thanks. Axel, you've already made the point that you think the bulk of transmission is ahead of us, but other points you want to make?
Sorry?
No, sorry, for Axel.
Oh.
For Axel.
Well, sorry. I already said, and I think there is some transmission still in the pipeline. When I was at a central bank, which is already sort of more than 15 years ago, so quite a different set of reaction functions at the time. One thing that is not taken sufficiently in account when you look at resilience is two factors. I think you put a finger on it. First, this massive fiscal transfer of income really led to precautionary savings because of a huge amount of uncertainty at the time when it was issued. So it didn't lead mechanically to the same reaction and investment and consumption that you would have seen if we'd not moved into such an uncertain period. And I don't think we've exited uncertainty. I think all decision making now has a really strong cautionary element, and uncertainty and second moments play a much bigger role in decision making nowadays than, and they should, because if you're in a more uncertain environment, you just take less optimized decisions and add a sort of buffer or a sort of an uncertainty band to what would otherwise be a first best choice. And I think we're seeing some of that play out. Second, don't forget that in the US, the current deficit is at 8.5% fiscal deficit. So it's not as if we're seeing a normalization of fiscal and monetary policy in sync. We've seen fiscal policy almost being at an unprecedented, I sometimes call it wartime level, and that will not go on. And what we will see when you look at fiscal and monetary policy is there is some fiscal normalization baked in, because once it stops being expansionary, almost mechanically, the reduction of those deficits, which is likely to come, in particular going into an election year, will add some tailwinds to the economy by a restrictive monetary policy that might go on neutral in the sense of keeping rates where they are, in particular in the election year, but fiscal policy being, in my view, way too expansionary still. And I'm not surprised that the combination of this expansionary fiscal policy and the labor market shows a strong labor market. Actually, structural factors in the labor market, participation rates, new choices, new ways of working, I wouldn't call a 3% unemployment rate an equilibrium rate. So I do not expect the reaction of the Federal Reserve if unemployment ticks up from 3%, because that's ending in a period of a really tight, maybe overemployed labor market, into something that might be a more normal labor market, which I usually have at around 4.5%. So if you look at the typical reaction function of central banks, if the labor market cools somewhat, that's part of the monetary policy desirable transmission. And don't expect the Fed to react to it, because it's part of the menu of cooling the economy and prices. And I expect the Fed, when they look at their dual mandate and their objective function, that inflation will be within a sort of error band of where they want it to be, and unemployment will be higher than it is now, but not really out of whack with what you call a reasonable number of unemployment, close to full employment under new choices in the labor market, people staying out, people working less. So there's some structural factors there. I expect monetary policy to go sort of more or less straight ahead at the new level at which interest rates are. And I see a lot more structural factors, which we haven't talked about, why interest rates and inflation may structurally be higher again than in the last sort of 10, 15, 20 years. I mean, aging is going to stay there. And so we have a lot of deflationary forces that are still there. But the most deflationary force has been the integration of China into the world economy over it's what I call mega globalization. That mega globalization with the discussions around China has come to an end. So the downdrift that we've seen in global, production factor cost in inflation in all of our economies by adding China to the global labor market, that will not be there. So I do think that we'll probably see more balanced inflation rates, not ticking down towards zero again, but the new normal might be inflation that is sort of more sticky at around 2%, where central banks want it to be, than them having to sort of bring rates down again to fight another risk in the economy, taking more of a cooling.
Okay, so that's actually a great segue to the next sort of block of issues I want to get into, particularly, is the last mile the hardest in getting back down to 2%? I want to see who actually agrees with that. And then relatedly, what are sort of the markers that you're looking at? I'm asking this to the whole panel. What are the markers you're looking at to validate that you're on the right track? Is it, do you need to see labor market slack? Is that a necessary condition for inflation to go back to target? Are you looking at simply monthly run rates? If you don't see, for instance, service sector inflation starting to annualize close to a 2% target sometime in the next 6 months, is that a problem? What are the type of things you're looking at? So why don't I start, Axel, I'll actually start with you, Axel, because you raised a point. And I'll give you the opportunity to talk a little bit more about, so I'm in the opposing camp, so in the interest of transparency, so I don't think the last mile is necessarily the hardest, and I don't think structurally anything's really changed. But for you, labor market slack, Axel, is that for you a necessary condition to get back to central bank targets, or could we get there without unemployment going up?
So you can see we don't have our discussions anymore that we did have until a year ago, because I do think that the last mile is, bringing inflation down to 2%. It's not necessarily going to be more difficult, but what I think is important is to reestablish that 2% in all wage price dynamics. And what you've seen in the labor market and what you've seen, you will have to some degree kind of stick to 2% for much longer than you would usually have to, because you need to reestablish some of these credibilities that is really the objective. And so I do expect that central banks will be quite focused on that, pretty much independent of what sort of short-term movements in inflation do. And dare I say, look, we've just had unprecedented events in the Middle East. We have this war in Ukraine. there's so many uncertainties that, I think the flight path ahead for central banks is much unclearer because inflation and the economy is still coming out of what was a series of unprecedented shocks. And so I do think it helps that the central banks, having sort of kind of gotten it wrong in the start, now are a lot more humble and I think, do not really want to give such precise guidance on what is in the pipeline because, as you said, many of these areas are new to the central banks as well. And this pretense of knowledge that we sometimes get when we look at projection, that's kind of probably now central banks move to what I take more is a risk-averse approach to monetary policy, which basically means they won't optimize some of these wiggles in the economy. They kind of try and see through it and really move to more robust policy making. And I think that in itself will lead to some more persistent focus on 2% being achieved. And I think even if inflation shortly dips under 2%, they will not take that as a sign of all clear. They will not sort of then change their course. They want to see inflation established over a longer period at 2%, and that's going to be difficult because there will be new bumps in inflation that will tick it up, and they just have to make sure that they're not going to tolerate those.
Thank you. Chiara, what are you mostly looking at to give yourself comfort that we're on the right track to the projection?
Well, I think that, as I already mentioned, we all agree that inflation has been coming down, but not everywhere, not uniformly, and what we need to make sure is that the progress will be sustainable, and so we'll get there, as Axel mentioned, but we'll also be able to stay there. So there's been a lot of discussion about the labor market and inflation, what causes what. I think that regardless of the causality, everyone agrees that a hot labor market, high wage growth is not consistent with 2% inflation. And so in this sense, I am looking at the labor market to make sure that things will improve. There are at least a couple of forces, I think, that have helped bring inflation down. I mean, there is the fact that all the supply, or most of the supply constrained have eased, and we've seen inflation come down, for goods and those parts of the inflation basket. But then, you've also seen the impact of monetary policy that is making its way through some of its way through labor markets, and we clearly need to do more in that to make sure that we'll get to a sustainable inflation, and just of 2% at the 2% level. And just to go back to the discussion that I was, briefly touching upon before, one thing that I'm personally looking at is, the Beveridge curve, the Phillips curve, so the relationship between vacancies and unemployment, between inflation and unemployment, because they've been behaving in a very unusual way. And at the moment, we're really in this situation in which we're having the benefits of lower inflation without the costs, the sacrifice associated with it. And it's clearly a fine line until, we get to the kink. And so it's really trying to make sure that, we get where we need to be without doing too little, without doing too much. So these are the things that I'm looking at when assessing, whether we are on the right path to get there.
Okay, great. Hugh?
Yes, thank you. I mean, I agree very much with both the previous interjections. I do think it's absolutely crucial that we reinforce the 2% anchor, and that ultimately has to be the focus of policy, as I said earlier. I think, the way I would read it, and again, relative to, larger economic areas like the euro area or the US. I mean, the UK, more small open economy perspective would be, we have been subject to big external shocks, and we are a price taker, for example, in international durable consumer goods markets, etc. So quite a big impulse to headline inflation has come through that. It's come through energy, it's come through food prices, all of which we're a bit net importer of. And I think that has, a number of effects. One is it focuses attention for us on things that we can control, which are the domestic implications of those shocks. And that goes back to the whole discussion of second-round effects and whether price-setting behavior, cost dynamics, wage-setting behavior within the UK economy are compatible with our target in the face of these significant shocks that have come from outside. And I think related to that, and this is an important point, is because we are a large net importer of all of the things that have gone up dramatically in price, I mean, that has weighed on UK national income, but it does beg questions about, in order to re-establishing domestic purchasing power, do we want to see some catch-up? Does that impart some self-sustaining momentum into domestic inflation that we need to be concerned about? So these two things seem to me at least to be somewhat related or back-to-back with each other. And it does require us to revisit a sort of earlier literature about price dynamics associated with attempts to sustain real spending power, real income resistance, those type of issues. And I think that puts a lot of focus on the cyclical behavior of profit markups, wage markups, and so forth in the economy. And I think that's a very big focus of our attention. So just to come to your sort of the guts of your question, what are we looking at? I think the bank's been the MPC has been pretty explicit that we are trying to look at indicators of underlying or more persistent inflationary pressure. So look through the impact of these external impulses to try and identify, and we have identified three: services price inflation, wage developments, and the tightness of the labor market. What I would emphasize in that is, in our assessment of those three things are seen as indicators of this underlying persistence. They're not necessarily causal drivers or the only drivers of that underlying persistence, but they're things that we see, hopefully relatively timely fashion and in a relatively meaningful fashion so we can interpret. So they're more indicators rather than causal story. And I think even beyond that, it's also important to emphasize that identifying those sort of three areas does not identify any individual indicator in that area. As I said earlier, one of the challenges we face is that the set of indicators in each of those spaces, they don't always give entirely consistent signals. And as is the case, we're always trying to separate signal from noise, and we're always trying to focus, as I think Axel was talking about, not on just the next step ahead, but really on the implications over the medium term at the monetary policy relevant horizon, because those are the things that are really what persistence means. It means that that impulse to inflation will still be there at the time that the lags in monetary policy transmission unwind. So it's relevant to our decision today. So I think if you kind of couch those three sets of indicators that we've highlighted, but put them in that context, that would be the sort of way we are trying to think about this.
Robert, I guess in the Eurozone, it's wages first and foremost, right? Would you agree with that, or are there other things that you're looking at?
Yes, and what we try to do is to monitor on a at least quarterly basis what are the drivers of inflation. And so far, also internationally, one was only able to define what drives the GDP deflator, but this one does not take into account the influence from outside. And happy to say that now we succeeded, not only for Austria, we'll use it for the euro area and also for the US, to have to be able to disaggregate the drivers also for the headline inflation, which will allow us to understand much better what is happening. And this gives a quite good impression about the different areas like profits, wages, but also, of course, the energy, which is still, and is, I'm afraid, will remain an important driver. And so we have a pretty good understanding of what's happening there. But in addition to that, what I'm afraid of is that demography, which has been mentioned, I think, by all us, will remain a major driver. And it was mentioned that changes receive quite some additional offer when they leave her, and this is something which will increase the speed with which people change. And what we also have, I think, is that in in European economies, I assume also in others, is that we have a high level of specialized workers that retire now. And this creates a major pressure for the industry because they're not easily replaced. And they cannot be replaced by migration because it takes more than a year in order to get the specialization level. So for me, the question of retirement age becomes a major part, but this is something which is perhaps political, not the one that policymakers want to go to it. And the other part is, which is outside this immediate concern, is besides the drivers we're talking about, we have the climate change, and we have not yet any kind of major developments which bring this really to the price table. And this will happen in the future because climate change won't be cheap. It will require additional resources, and the resources and on the other side, the financing for this has not yet been determined. So labor market and climate change are two major current and future drivers for us, which will make it very difficult, I think, to go back to the 2%. Or if it happens, then with a recession which goes beyond what we currently envisage, so below 1%. I hope this won't happen, but I don't see at the moment the mechanisms to avoid this price pressure and hence the capacity to move quickly to the 2%.
So let me just ask you the question the following way. So the ECB, after the last meeting, it still has an inflation forecast that's very elevated next year and even above the target in 2025. Is there anything? So obviously, there's a reliance, I guess, on going back, shifting confidence back to the forecast. Your colleague Klaas Knot said something along those lines yesterday, where the models were broken, but now the models are starting to work again because some of these shocks are dissipating. But does that imply? I mean, so my question is there anything in the next sort of 6 months that is going to invalidate the forecast that you have? Because a lot of the things you're laying out are sort of quite slow moving and structural. Is there anything sort of near term that could already sort of lead you to want to change course?
One claims that the projection models have improved, and so they have been more correct. I'm not so sure about this one, simply because if and as structural changes take place, they're extremely difficult to build into models. So, and models are by definition wrong because they only present some part of reality, but they don't represent what happens recently. And these structural changes, I don't think they have been modeled, so they have to come from the outside. And that's the number one. The other part is that all these projection models have by construction, the end value is the target rate. So it always goes there. So by definition, they are biased. So for this reason, yes, 1 year, fine. But what happens in 2-3 years based on these models, I'm always rather cautious. And in our case, we predict for 2025 over 3%, not only slightly over 2% inflation rate.
Okay, so most of, I think the tone of the discussion has been about that there's still some, we're not in the clear yet on getting inflation back to targets. There's a lot of transmission to come. But I want to talk a little bit about what comes next, which is the exit and the easing cycles. And I'm going to come to you, Hugh, about your Table Mountain speech in a second. But so first, just as an observation, I think one thing that's been sort of fascinating, I think, to all of us in the market is if you look at what's priced into multiple G10 markets right now, we have real rates out across the entire forward curve that are basically implying that the landing zone is going to be hundreds of basis points higher than it was pre-pandemic. So the Fed funds rate never comes back below 4, the ECB policy rate never comes back below 2.7. So all these curves actually look remarkably flat and quite similar. And so one set of questions is, why is that? And are markets interpreting what the central banks are saying correctly? And so, of course, one of the big themes, and Axel highlighted as well, that central banks have been very vocal about their determination to get back to 2%, and they have this high for longer narrative. And so, but there's a distinction between high for longer nominal and sort of high for restrictive for longer, right? They're not necessarily the same thing. And so I know this is why I'm coming to you, Hugh, because the FT, after your South Africa speech, they had this graphic in the paper, which basically was sort of a high nominal for longer. But just as an example, like if the Bank of England doesn't raise rates between now and the end of the year, the real policy rate goes up 100 basis points on our sort of inflation forecast. By May, it goes up 200 basis points. So high nominal for longer actually implies increasingly restrictive for longer in real terms. And so I know the last statement from the Bank of England actually used the word restrictive for longer, not high nominal for longer. So I'd like you to sort of comment on how you think about sort of what's now priced in the forward space and what sort of the reaction function is to ultimately reverse the tightening.
So, perhaps it won't surprise you, but I'm not really going to answer that question head on. I'm not sure it's a very sensible thing for policymakers to comment either about FT articles in general or about the sort of forward path of rates as priced by markets. So, in a way, I'm going to quote back to you things that you said in your preamble. I think one of them is we're not done. It's premature, in my view, from a policy perspective, to talk about the unwinding we are still in a phase of ensuring inflation goes back to 2%, and we should not be deflected from that phase. The second thing I'd say, which goes to your point, which I think is well made, that the notion of restrictive, which has been used in different ways, or at least been used by all central banks in various ways, or large central banks. Implicit in that probably is some notion of R star, but I think R star is a very elusive concept. I think it's not a desperately well-defined concept, to be very frank with you. And we could discuss whether we're talking about sort of a low-frequency, long-term R star, where there are reasons to suggest that, because if that's driven by technological factors and demographic factors, have those fundamentally changed over the last time? Well, some people think AI has fundamentally changed them. We could have that debate. But I think your point was that, at least as a starting point, it's not self-evident that you would. So there's uncertainty even about that longer-term concept. I think there's much more uncertainty and probably more conceptual uncertainty, let alone measurement uncertainty, about higher frequency measures of R stars. To me, I think the sort of question is a good question. I think Chiara and others at the Fed have spoken about the different components of why markets might be pricing. Is it term premium? Is it changes in inflation expectations? Is it changes in R star real interest rates? I think all of those things are possible. I think it's premature to come to a strong conclusion about that. So pragmatically, I think when you look at the outlook for interest rates, I go back to where I started, is that you have to do what you need to do to get back to 2%. And I think the concern at central banks has been, or at least a concern that I have, which led to the speech you referred to, has been that we have become a bit oversensitive or perceived as oversensitive to very short-term developments in the data. Whereas I think our focus has to be a more medium-term focus. And if the concern, the last mile, is about some sort of self-sustaining momentum in domestic inflation, which is driven by some combination of pricing behavior, catch-up effects, etc., then there is going to be a need to address the persistence that is inherent in that type of dynamic. There's going to be a need for a persistence in the policy response to it. So the idea that policy stance can or would or is likely to sort of turn on a sixpence seems to me to be overdrawn.
Okay. Great. Axel, you're not at all constrained. You can say whatever you want. So what do you think the easing cycle looks like?
Look, after 10 years of not going to Jackson Hole because the financial sector doesn't usually go there, and I ran a large bank in Switzerland, I've been back in last year when Jay Powell gave his speech and going to reaction functions. He made one thing abundantly clear. It was a very short speech and very determined. But he used the historical comparison of Volcker at the time, and that was this part that was mentioned. But he also mentioned Arthur Burns. And it's not that the Arthur Burns central bank at the time hadn't raised rates. They just prematurely lowered them when they thought the economy cleared. And this reference to both Arthur Burns and by Jay Powell and Paul Volcker, it was pretty clear which side of those two archetypes of central bankers he would want to be. And that means for me that in any discussion about reaction function, I took away from that the chair clearly is not going to prematurely be reducing rates before it is established that the new normal is inflation around 2%. So central banks will be more conservative than they need to be on average had the situation not been one where inflation has been running out of its usual confidence level for the central bank such persistently. And I do think that models don't show that. Look, and I think he came up with what Robert said. The question is, if you have 2% on the policy relevant horizon, so December is for me the sort of, the last months of the year, the first time we will see 2016 in the central bank projections. I expect the central banks to do another move. I call it the bullet to the brain of the beast of inflation, because I think they would just make absolutely sure that they can communicate going down. A lot of things will happen then when the next likely move of central banks is a lowering of rates. It will not come soon, but people will start in financial markets to take longevity risks again. And the whole thing about all these models is they're real economic models. They don't have any of the transmissions we talked about into them. The biggest part of why you have lags in the economy and they're long and variable is the whole transmission through the interest rate, exchange rate, portfolio balance, income and wealth channels, and none of those is in these models. The models at 2% 3 years out is a recognition that all the shocks have started or stopped moving the model. Do you take that as a confidence in the projections 3 years out, or is it more a health warning to projections 3 years out that the economy just doesn't move because new shocks have an expected value of 0? The one thing I know for sure, as somebody who lived out there in the real world and in the central banking world, whilst the expected value of future shocks is 0, the likely materialization of future shocks has a non-zero probability. Let me put it like that. That's a minimum, I think, warning you need to understand. And since it's very hard to put numbers on what is likely to happen, central banks have started to use this concept of upside risks and downside risks and uncertainty being elevated or uncertainty being low. We are in a period where I think despite inflation coming to 2% maybe in a year or two, there are still upside risks. Robert mentioned some of them, and there is increased uncertainty around policymaking. So I expect rates for longer and restrictive for longer just because there is an option value in waiting for inflation to be anchored and re-anchored at 2%. And there is very little benefit that I see by moving prematurely and having to reverse course. The worst thing central banks can do is be seen reversing course. So I think the central banks will largely stay longer at a higher level and not reverse course, but then follow a declining inflation in terms of easing. And that might just be somebody who sort of did policy 20 years ago, but I think that would be my recommendation or my expectation.
Okay, I want to go to the audience. I want to ask one last question to Robert about the balance sheet, and then we'll go to the audience with questions. So Robert, so you mentioned in your opening remarks that you are keen to get the balance sheet down as quickly as possible, also to prepare for potential future reuse. What are sort of the type of things you're thinking of in doing that? Are you I mean, I know you've put proposals out there to increase the minimum reserve requirement very substantially. Are you thinking about pulling forward the end of PEP reinvestment? What kind of things are you thinking of?
What I'm worried about is that the future monetary instruments with the ones we used recently, because we won't have new, so it will be perhaps negative interest rates. We will have again quantitative easing. We may have delta again, some way of supporting the banking system. And what all this does is that it ruins our balance sheet. So it bloats us up. And if and as, then we have in a current floor system that we pay the banks now 4% on an overnight account on the safest amount of money what we have for, which means that our profits are shared to 100% with the bank. We have no share in it. And as a result of it, what happens is, on the other hand, our assets have close to nothing. The difference is a loss. And if this continues, we will soon have negative equity. And negative equity, in principle, banks, central banks can have negative equity, albeit not the rules by the ECB. Currently, they predict, well, a little bit, but after some time, you will have to recapitalize. But does it mean if a central banker at the national level goes to the Minister of Finance and says, listen, I need a few billion, could you give it to me? I don't think this is very supportive of banks' independence. So what I think we need to make sure that our balance sheet is in order. Now, this can be done in a way that we move from the floor system again back to the corridor system, which would then have a different policy rate, and the deposit rate would be much lower, which means our losses would be low. But it also means, and this is my proposal, is that we say that, call it higher reserve requirements, or put more neutrally, we don't remunerate 100%, but only 90% of our deposits. With the current deposit rate, which is the deposit rate and not the lending rate there. I think this is something which would allow us to be ready when the next crisis hits, where we will again have to use quantitative easing. This would allow us to be in a state which somewhat survive, but not with great colors, but at least in a positive territory.
Great. I promised some time for audience questions, so please raise your hand if you have a question. We'll take a few and then get the panel to respond. First one here. Do we have a microphone? Second one over there. The microphone on the table should work, but they might bring you. There we go.
Hi, Phil Aldrich from Bloomberg. It's a question for Hugh. Mr. Holtzman has been talking about the implications on bank balance sheets of quantitative tightening, or the ramifications of QE. In the UK, there isn't a problem for the bank's balance sheet because you're indemnified by the government. But there is a big fiscal implication because so much money is being transferred from the Treasury to the bank. So is this, is Mr. Holtzman's proposal something which could be considered in the UK, because the bank is in the middle of effectively a giant fiscal transfer that's going on at the moment?
I will take a few. So, a second question over there.
Can you hear me? Yeah, okay. Thank you, Søren Rade, Point72 Asset Management, and I wanted to congratulate the panelists for what was a very interesting discussion, certainly for monetary policy nerds, followed by two questions to Mr. Holtzman and Hugh Pill. I wanted to sort of ask the reverse question that was just asked of Hugh Pill of Mr. Holtzman. Could you take a leaf out of the BOE's playbook and perhaps think of balance sheet tools that accelerate the shrinkage of the balance sheet, like active sales or PAP reinvestments to curtail the losses? What are your thoughts on that? And then to you, Pill, you talked a lot about structural shifts in the economy, a conundrum of the labor market resilience. What are the implications of that for your tolerance towards rises in the interest rate, in the unemployment rate, which we have seen rising in the UK for the better part of a year, unlike in other economies? And still, the mantra that you're very much following is patience, persistence in the face of, that ostensible increase in the unemployment rate. So just wondering, again, to put it in more nerdy terms, your thoughts on NIRO and how that has evolved. Thank you.
Okay, why don't we have you go first, Hugh, and then we can take some more questions later.
working? No. Oh, there we go. So let me first, address Phil's question. So, I think it is important to recognise, as you did, that the arrangements in the UK are quite different. And so I don't think there's an immediate read across. Not least where monetary income or seigniorage or whatever you want to call that goes, that accumulates first at the ECB, as I understand it, but it doesn't accumulate at the Bank of England. So that's a very, very different setup. And then the second thing to say is, we are dealing with decisions, or we are facing the consequence of decisions made in the past, in some cases a long time in the past. So they are playing out. So I don't think that that is a consequence of those decisions. It's not an active set of decisions that is being taken now. And I think it's premature to speculate on what we might do in the future. And crucially, as you know, from the bank's point of view, and particularly from the MPC's point of view, the MPC has to, going back to the very first comment I made at the start of the session, has to have the independence to set monetary policy on its own terms. Now, one part of that has been, given the events of the last 15 years, setting the amount of QE, being able to determine the size of gilt holdings held within this asset purchase facility vehicle, which is the mechanism by which that has been done. And that has to be done independent of these fiscal and other considerations. That's a logic of having an independent monetary policy. And so the Monetary Policy Committee, before I arrived, set out the principles by which it would do that. And at the heart of those principles are they would behave in a way which was predictable and gradual and so forth. And that has a set of implications. So I think we have followed those principles in what we did this time last year, and we've done again now. That is playing out. That does have some of the consequences for cash flows and so forth that you define, but those are not unanticipated. They are predicted, and they are factored in to our framework, but also other frameworks that have to take that into account. So I'm not sure that's an answer to your question, but that is the state of play. Then on, I don't know if you want to also follow up on that, or shall I do the second question? Okay. So then on the second question around the unemployment rate. So I think you're right that there is, the facts of what you say I agree with. I think what we get to there is a question of this interaction between understanding the behavior of that persistent component of inflation that we are concerned about, and that ultimately we have to do something about. So, as I said earlier, I would define persistence here as being still in inflation at the time of which the lags in monetary policy transmission imply that policy decisions taken today can have an effect on it. Right? So that's the sort of logic, I think, of what persistence means. And so that's what we're focused on. Now, of course, we have to behave in a forward-looking way, precisely because of those lags in monetary policy transmission. And what we're trying to understand is how behavior in price setting, in cost dynamics, in the labor market, including in wage setting behavior, is relevant for at that type of horizon. So when we look at the unemployment rate, big picture, we are still of the opinion that domestic wage dynamics are important. They are influenced by the tightness of the labor market. There's a question about what is the best measure of the tightness of the labor market. Historically in the UK, we have tended to look at the unemployment gap, so the gap between the unemployment rate and the NERU. The NERU, like our star, is something that's easier to define and measure after the fact than in real time. So, we need to be, I think, humble or realistic or about our ability to measure it in real time. Of the measures that we are using, the unemployment rate has historically moved quite closely in terms of correlation with things like the ratio of vacancies to unemployment, or the churn rate, the ratio, the pace of which people are quitting and then to take up other jobs. In the recent period, for reasons that I think we don't fully understand, there has been greater dispersion across those potential measures of labor market tightness. I think we have tended to put more emphasis in our communication and analysis on the ratio of vacancies to unemployment, which has come down, indicating some loosening in the labor market, but still remains above pre-pandemic levels, and pre-pandemic levels were quite elevated relative to historical levels. I mean, there are some issues about whether the statistics used to measure vacancies in a world of online recruitment platforms are consistent through time. So, we face the normal challenges about how to interpret noise and signal and whether that's a trend development or a short-term development. But I think the unemployment rate is clearly an important indicator, but it's not the only indicator of how we assess the labour market. And just on your point about the NARU is the natural benchmark. The NARU is an elusive concept. We talked quite a lot about a whole set of things that might influence the NARU in a very long-term sense, so demographics is clearly one. But of course, there's also potential reasons for the NARU to move at a higher frequency basis. And for example, as I said earlier, the implication of some of the shocks we faced, notably the deterioration in the terms of trade. I mean, the literature of the early 1980s, the Layard, Nicol, Jackman type literature would suggest that those types of shocks do have a sort of relatively high frequency impact on the NARU. So, I mean, that is something we also take into account. But I think the main message would be, as I said earlier, we're trying to interpret wage developments and labour market developments through the lens of looking to this persistence, this medium-term orientation, and we're trying not to focus just on any one indicator, but see it in a holistic way across a range of indicators.
Robert? Did you want to?
Yeah.
Yep.
On the questions, number one is, I think, to give an answer, one can think about the central bank and the treasury as one sector, which is only separated for reasons of governance in order to allow a better policy. If this is the case, then of course, then you would make a difference between who determines what. And going back to the government to ask for money is not a good way in order to keep the separation. That's my take. Second part of it is, of course, one could imagine another way of doing it, simply allowing equity becoming negative and never become positive. This is happening. Behind you is the former vice governor of Czechia, and there, even the operational expenditures have output and added there, and if ever any kind of deficit added there, so you will have a negative equity, and you leave it as it is, so you never pay back. That would be one possibility, currently not envisaged the way how the ECB is running, because there's a strong recommendation. Eventually, it needs to be recapitalized. Independent of that, the question is, different systems of running monetary policies have different ways of distributing, if you want, so the earnings of monetary policy between central banks and private sector. If you have a floor system, as we currently have, the deposit rate, which is high now, determines in full the expenditures of the central bank compared to revenues close to zero. If we only had now a corridor system, we would have a policy rate which would be the lending rate, not the marginal lending rate. The lending rate would be 4%, and perhaps the deposit rate only 3 or 2%, depends on the floor there. So both make a difference how much you give to the private sector. And as it is not only a monetary question, but also something which has to do with the balance sheet, also central banks have to think in balance sheet terms, and hence my proposal there, which, how to say, takes a little part of these enormous profits of the private banking system back to the central bank. Only 10% of the 90%, which I think is pretty decent.
Thank you very much, Robert. You've got us right on time. We've run out of time. I'd like to thank the panelists for a great discussion. Please join me in a round of applause, and thank you for attending.
Ladies and gentlemen, We will now take a coffee break at the foyer behind the conference room. We will reconvene in the conference room at 8.